In this next lesson, we'll be talking about the distribution pre-alert indicator. It's a follow-on from the accumulation indicator, and the two are often used together. Some of the contents we'll be covering in this session include applications of the indicator, some of its features, parameters to vary in the indicator, some of the advantages and disadvantages of the indicator. So distribution pre-alert, the signal identifies a pattern of increased activity at a new high price in the share. May signal the smart money selling out of an overpriced share and taking their profits, and can become an early warning to a potential reversal in the trend. It's useful when looking for a short position entry. So short selling is all about trying to profit from an expected downturn in a stock. Typically, these sort of trades are done using derivative products such as CFDs. It's best used when the share or market is in an overall downtrend or sideways trend. The idea is to trade with the primary or overall dominant trend, identifying peaks within that trend as possible short selling opportunities. So you can see an example of a downtrending situation, and as part of that downtrend, you'll often get these little counter rallies against the downtrend. And as it rallies, it'll trigger these distribution alerts on the rally, suggesting selling pressure coming in on this rally, and a possible resumption of that downtrend is likely at some point. And hence, that represents an opportunity for short selling. So here's a chart that kind of exhibits distribution alerts triggering on these peaks prior to possible downturns. So again, it can be quite early. It can trigger sometimes weeks before the final high comes in. So it's very important that you also have some sort of reversal signal before you act on this indication of a possible top and downturn. Now, the other way you can use distribution apart from short selling is as an exit signal or hedging signal for stocks that you've bought or are in long positions. So it's useful when looking for a long position exit or a hedging signal. It's best used when the stock or market is rising or in a sideways trend. The idea is to identify the peaks in that overall uptrend where a possible down reversal may take place. So you might have bought it back here on this pullback. It's been rallying, it's going up. We start seeing some distribution alerts triggering on the way up. And as a result, we might tighten our stop or get ready to hedge the stock because it's suggesting the possibility of a downturn from this level. Okay, so here are examples of rallies that have occurred on an uptrending stock before declines have taken place. So we could use these distribution alerts as a bit of an early warning to a possible decline in terms of taking profits or tightening our stop losses or even hedging a possible downturn on the stock we're trying to hold for the longer term. Again, very important to wait for that reversal signal to be present before exiting or hedging a position. Now you can, of course, do a scan for distribution as well. You'd mainly do a distribution scan if you're a little bit more advanced and you're into short selling with CFDs or you're trying to get a few put option trades away. That would be a good time to be scanning for distribution. You could try 34 periods, 3% drop, or 1 for the volume, and scan obviously whatever watch list you like, top 20, top 200. Otherwise, if you're just using distribution to manage a few shares you own, just make sure distribution is part of your chart template. And as you look at your stocks whilst managing them, you'll see distribution alerts triggering in their uptrends as the uptrend unfolds. And then it's a matter of managing that stock, waiting for that reversal to either A, sell the stock or tighten your stop loss, or generally even consider hedging the stock if it starts to turn down from those levels. All right, some of the variables associated with the indicator, probably the main one you want to think about is what period setting you're going to use. This refers to the number of days to be included in the search. So typically you might use 34, 55 period time frame. The system searches for and identifies a previous resistance point. It averages the volume over your time frame. So if you nominate 55 as your time frame, it's going to average the volume over 55 days and look for the volume to be above average. Obviously, also identifies the most recent level of resistance. Now, typically that is just a minor peak. It's looking for it to break up through that peak by as much as 3%. And when those three things all come together, you start triggering distribution alerts on the charts. Smaller period settings will identify more opportunities and can be useful strategy when scanning a higher time frame weekly charts. So imagine a 13 period accumulation distribution alert on a weekly chart would be pretty interesting, a possible significant high there. Or if you had 13 period distribution on a daily chart, it would be suggesting typically a short-term minor peak before a short-term correction is about to get underway. Larger settings like 55 will identify fewer selections, but they are more likely to be more significant in terms of their reversals. Percentage rise identifies how much the stock has risen in percentage terms from the last level of resistance. So typically it's looking for it to break up through a minor peak by as much as 3%. Large percentage rises indicate significant buying pressure. So it's important to wait for a convincing break of upward trend line or moving average or ATR trailing stop dots, whatever you're using as a trend reversal signal. It's important you wait for that trend reversal signal to happen before taking profits on a long position or hedging a stock or short selling, depending on what you're trying to do with this indicator. Volume is an integral part of accumulation and distribution indicators. Again, they're one of the few indicators that actually study volume. So basically, once you've nominated your time frame, it's going to average that volume over that period of time and simply look for the volume to be above average. If it's for accumulation, that would suggest buying pressure. If it's for a distribution, it'd be suggesting selling pressure. For an ideal setup, you'd wish to see increasing volume, indicating liquidity and participation by larger players in an overpriced market. It's always preferable to see an increase in volume over a number of days rather than just a singular day of high volume. Things you can do in terms of scanning. So once again, you'd pretty much only scan for distribution if you're looking for short selling opportunities with CFDs or maybe put options. Otherwise, you'd just mainly be including distribution as part of your chart template. You can nominate your date and time frame. You can scan prior dates, but generally if I do a scan, I would do a look back. So I might do just a 5-day look back, and you tend to pick up more opportunities when you do a look back. You can also scan different time frame charts like daily and weekly charts if you wanted to, and sometimes you get different sort of results by doing that and more opportunities. There's also a price and volume filter, allows you to filter the price of the shares that you're looking for and even the volume criteria you're looking for. And these are the 3 bits of information that need to come together in order to trigger distribution. So step 1 is choose your period setting. So let's assume in this case we're using 34 periods. Once we've nominated our time frame, it averages the volume over 34 days and then looks for the volume to be above average. It also identifies the most recent minor peak, so normally just a little minor peak like this. Looks for it to break through that peak by as much as 3%, and when it all comes together, starts triggering distribution alerts on the rally, suggesting a peak and a possible downturn. And these are some of the different settings you could experiment with this indicator. So short-term setting, try 13 periods, 3% rise, 1 for the volume. Medium-term settings, try 30 or 34 days. 3% rise through resistance, 1 for the volume, or 2 for the volume. So if you use 2 for the volume, it's looking for double the average in volume. If you use 1 for the volume, it's just looking for the volume to be above average. And you'll tend to get a few more opportunities if you just use 1 for the volume. Looking for a longer term setting, try 55 periods, 3% rise to resistance, 1 for the volume. Okay, so that's the basic concept, exactly the same as accumulation, but in reverse. Accumulation identifies trough lows and rallies. Distribution identifies peaks and declines. So there's your 3 bits of info required to trigger distribution. Specify your time frame. It'll then average the volume over your time frame and look for a percentage rise through resistance. And when those 3 things come together, it starts to trigger distribution alerts on the chart. You can also get multiple alerts, consecutive distribution alerts on a number of peaks on the way up as part of a trend. So it can be quite early. Sometimes it can be a month early before the final high finally comes in. So it's important that you got some sort of reversal signal to look for before exiting or hedging or short selling with this indicator. So multiple alerts give us an indication that the stock may be finding resistance around these levels. Remember, the signal is quite preemptive. Always wait for your trend to reverse before you act to get in or out or hedge, or however you're going to use the distribution alert. Stick the stock in your watch list. I'll obviously keep an eye on it before the reversal actually takes place. Advantages of the indicator. The signal is an early alert to potential trading opportunity. It alerts us to shares that are trading at a premium price with increased participation. It allows us to be prepared ahead of time to take profits and or enter a short position. Remember, short selling is all about trying to profit from an expected downturn. An alternative to short selling is to hedge and essentially, ride out a possible downturn on a stock you're trying to hold for the longer term. Usually that's done with a derivative product such as CFDs or a put option. Disadvantages of the indicator are the signals are early, so don't treat them as automatic action signals. Share price may continue to trend in its upward direction for some time before the reversal takes place. And that's an important point. Sometimes you can literally be early by as much as a month before the final high will come in and a reversal happens. So it's important that you wait for that reversal before acting on the signal. All right, little exercise for you to do at home. Use distribution alert to scan the market for signals. This could be useful if you're trying to find a short sell with CFDs or a put option. Analyze the trend, support and resistance of the selection to see if it's uptrending. Is it testing resistance? Is there a reversal starting to take place? Place those that meet your criteria in a watch list and monitor them, obviously, for the reversal. Wait for the trade setup to happen before you take a short position, whether it's a paper trade or a real trade. Transfer the stock into your paper trading portfolio and then manage the trade until being stopped out. The other way you can look at distribution is on stocks that you actually own. Have a look at where distribution is triggered on the stocks you actually own and how long it took before the reversal happened from those peaks. And that's our lesson today on distribution.